I'm Ben Reppond. Welcome to my YouTube broadcast. Today is July 10th, 2024. I'm going to begin with a piece from Warren Buffett, and this is a macro view, his view of what's going on in the market and why he is accumulating or has accumulated $189 billion waiting for an investment to buy. Take a listen.
But I don't mind at all, under current conditions, building the cash position. I think when I look at the alternative of what's available in the equity markets and I look at the composition of what's going on in the world, we find it quite attractive.
Warren Buffett is prepping for a staggering $55 trillion storm that has been brewing in the stock market for the last 15 years. Buffett's favorite stock market indicator is flashing alarm bells, warning that a 40% decline in the stock market could happen any day now. For background, Buffett is by far the most closely followed investor in the entire world. Every move he makes is scrutinized to the very smallest detail.
Okay, now to the dashboards. The first one is the indexes for the equity markets, for 6 equity markets and the long-term government bond. So the top 6 are the the Nasdaq 100, the S&P 500, emerging markets, developed markets, Dow Industrials, and Russell 2000 small cap index. And then at the bottom is the long-term government bond, ETF, TLT. So this has improved. We have 25 out of 28 green dots. That's good. And the only one lagging a little bit is the small cap index, IWM. So all the green dots are above their 20, 50, 100, and 200-day moving averages going left to right on the right side of the chart. In the center, you can see that for the week, there are 5 out of 7 that are positive and 2 that are negative. Year to date, in the next column to the right, is the year to date change. And that is starting with the Nasdaq 100, 21% up, 16% up, and then it drops down from there. And of course, the long-term government bond is still quite negative for the year, minus 6%. So the second slide is I take the S&P 500, break it down to its 11 component parts, 11 sectors, different parts of the economy, and how those did. And the last week is illustrated in the yellow box and year to date in the pink box. And you can see in the yellow box, it's mixed, definitely mixed. Some are up, some are down, meaning green or pink. In the year-to-date box, they are more positive. So you can see at the top the technology, and then financials, and then it goes on down from there. And the last 2 is real estate and telecommunications, and those are negative year-to-date. To the far right, you can see are these sectors above or below their 20-day moving averages, represented by a green dot or a red dot. Again, that is mixed. This is the line chart of the S&P 500 over the last 24 months. So 2 years of data. I drew from the bottom of this to the top of this, I drew a black arrow just so you could see the magnitude that the S&P 500 has gone up. So look at the increase and of course the Nasdaq 100 even more so, but look at the increase in the S&P 500, including the past 3 months or so. It's just gone up and up and up and continues to hit new highs, which it did last week. So yeah, very positive chart for the S&P 500. When I pull that down to a 9-month chart, not a 24, but to a 9-month chart, and put it onto a candlestick view, and if it is solid red, typically what that means is it went down for the week. But when it's hollow, that means it started low and went up higher, and that kind of looks like a candlestick. So you can see all of the weeks for the last 9 months where this has gone up, and I could push it back even further and get more of them. But including at the very end, the last week, look how positive that was. So, and again, represented by the black arrow going from the lower left to the upper right. I take the Nasdaq 100, which is the strongest index, I showed that earlier, and create a comparison or a relative strength. So look at the Nasdaq 100 as the numerator and the S&P 500 as a denominator. The broad-based index here and the narrower tech-heavy index on top. And if it goes up, what that means is that technology and the Nasdaq 100 is more positive than the S&P 500 or is less negative. Either one of those will push it up. And when it goes down, it's going to favor the broad market, the S&P 500, over the Nasdaq 100. So again, since the beginning of 2023, you can see the degree to which it's gone up. It went up a lot, and then there was this period in the middle where it went up and down some, and now it's going back up again. When I turn this around so you can experience the magnitude of this, I put same data, I just make the S&P 500 SPY, the numerator, and the Nasdaq 100, the denominator, and you can see the degree to which the S&P 500 has underperformed the Nasdaq 100, represented by how far it's gone down. The S&P 500 has two major component parts, growth stocks and value stocks. And I create a relative strength. When it goes up, this favors growth. When it goes down, it favors value. There are both in the S&P 500, but the degree to which it goes up tells you the degree to which growth has outperformed value over this period of time. This is an 18-month chart, so for that entire 18-month period, you can see from the beginning to the end that growth has outperformed value. Not every week, but over that period of time it has. When I compare the large cap S&P 500, the 500 largest companies, to small cap, the 2,000 smallest companies, and make the S&P 500 the numerator and the small cap the denominator, again, you can see the degree to which large cap outperforms small cap. So you could say large cap and growth are outperforming small cap in value. Or you could say the Nasdaq 100 large cap growth is outperforming everything else. And the charts look like this. The long-term government bond, TLT, is the ETF, has been in a period of decline for the last several years. This is a 54-month chart, so for most of that period of time, the long-term government bond, and you could say government bonds in general, you could say corporate bonds in general, have been in a period of decline. This is a period of deep decline, which they're not doing well. The dollar has continued to go up, and this is a 42-month chart, so this is a 3.5-year period. So most of that period of time, so let's say for the last 3 years or so, the dollar has rallied especially against other currencies, and that's the way you figure the dollar against other currencies. This could be typically European currencies and the UK, but it could also be Asia, Australia, South America, other currencies. And so it continues to do well, meaning that if we buy something or spend money in other countries, our dollar goes further, and conversely, when they invest money or spend money in our country, it doesn't go as far. Gold had a great week. Silver had a great week. The spike up in the upper right of the chart shows the degree to which gold is going up. I'm reading a number of articles. I'm not giving advice or recommendations, but I'm reading a number of articles that say that gold and silver are poised for another move up, a run on the upside. So, and this is bearing that out, that people are wanting to buy gold, and you will see in a minute silver. And this goes back to October, November of 2022. It's gone up and down, but generally speaking, it's gone up. Silver, even more so. So you see that spike at the end, at the upper right, that's last week. So a huge gain in silver this last week. Silver, as you can see, goes up and down a lot, more volatile than gold. When it goes up, it usually goes up quite a bit. And that has been the case this past week. This is a 24-month chart. When I put those on a relative strength basis, I make silver the numerator, gold the denominator. The degree to which silver has outperformed gold this last week is represented by the large spike up at the very far right of the chart. But you can see through that entire period, it is a lot of up and a lot of down. Gold outperformed for a period of time very well, but now silver is on a run. They're both on a run, but silver even more so. And one comment before I get into Bitcoin, I'll say this. I've said it a lot of times, and I'll say it again. I don't think of silver or gold as an investment. Personally, I don't. I own silver, and I think of it as a hedge against the devaluation of the dollar. And if the dollar becomes worthless, and don't say it won't become worthless, because every currency in the world has been tremendously devalued or no longer exists. There is none that would escape that statement. So to say the dollar's worth approximately 5 cents on the dollar since the Federal Reserve came out in 2013, some are much worse. And so gold has held its value based on buying power. And so if you want to retain buying power in the dollar and insurance policy against a decline in the buying power of the dollar, then in my opinion, there's no better way to do that than silver and gold. I know that Dave Ramsey and traditional financial advisors trash them, and I think the reason they trash them, the financial advisors trash them because they can't make money on it. And Dave Ramsey trashes it because when you call his show or log in, he sells your name to financial advisors who don't want you to buy silver and gold. So he trashes them. And I know that he sincerely believes that they're a bad investment, but that's a horrible statement because they're not an investment. You may look at it that way. I personally don't. It's protection against the richest people in the world own gold and silver, or one or the other. And the reason they do is the reason I stated. And these people, in my opinion, are smarter than Dave Ramsey. Bitcoin has been in a period of decline. And we have a Bitcoin model. We've been out of the Bitcoin market for quite a while, and we're just sitting in money market waiting for it to recover, but it continues to go down. So I don't know when that's going to happen, but the reason we manage it that way is because When it goes down a lot. When it goes up a lot. So we're trying to manage it so that we're capturing as much as we can on the upside and avoiding as much as we can on the downside. Volatility index, the VIX, V-I-X, continues to be very low, which means the market in general, the volatility of the market is generally pretty high. And so when the VIX is down around 12, where it is now, that is a good sign for equities, but you can see where it's been. Asbury Research has, of their technical indicators, they have 5 that are positive, 1 that is negative. That was the same last week, 5 out of 6. Their cross-asset allocation, or cross-asset relative performance, compares several types of assets. Stocks are stronger than bonds. High beta, high volatility, is better than low volatility. Large cap, better than small cap. Broad market, S&P 500, better than the blue chip, Dow Industrial Index. The technology, the Nasdaq 100, is stronger than the broad market, S&P 500. Growth stocks are stronger than value stocks. All of these things I've just shown you with charts. And then in bonds, corporate bonds are better than government bonds. And high yield is better than high quality bonds. Okay, the U.S. versus the world. The U.S. is doing better than a number of countries, and in the green boxes, I'm looking at 2 of them that are green in the last week, the last month, the last quarter, and that's Taiwan and South Korea. They have outperformed the U.S. But the U.S. has outperformed Brazil, Canada, Mexico, Switzerland, Japan, India, China, and New Zealand in all 3 categories. I have been using Thailand as a proxy for the weakest country relative to the U.S. I think I'm right. And so when you look from the beginning of 2023 to present, you follow that line. It goes up and down quite a bit. And then I tracked it with a black arrow. This is the degree to which the U.S. stock market, represented by SPY, is stronger than the Thai stock market, represented by THD. So on a relative strength basis, look how strong the U.S. is. Now, the U.S. is stronger, as I said, than a lot of countries. It's just the one that makes my point the best is Thailand. In gold and silver, these are the spot prices, meaning there's no markup. This is just pure spot price. You can't buy it for this. But the spot price of gold is $23.95, and as I said, that's been going up. That's an increase of 2.7% for the last week. Silver, without the markup, is at $31.25. And that is a gain of 7.1% for the last week. Very significant. That changed the gold-silver ratio down from 80 to 1 down to 77 to 1. A monster box, therefore, a monster box of silver is going to cost you more because the price of silver went up. It is now 16,820. I recall it being around 11 or 12,000 in the last year. So it has gone up quite a bit. And this includes the markup. The markup is now $2.40, according to my son Preston. And when you put that on top of the spot price of silver, for bullion, it is $33.64 for 500 quantity and $34.14 for 20 quantity. I've said this before, I've shown this before. J.P. Morgan said in 1912, gold is money. Everything else is credit. Or you could say is just a piece of paper. Thank you for watching. If you have questions or comments, leave them in the comment section below.